Okay, so everyone is talking about the government shutdown in Washington, right? But what if I told you the really seismic shift, the big one, isn't happening in politics, it's happening with our money? We're going to dive into this because what's going on behind the headlines is literally rewriting the rules of finance.
So, you've seen the news. Congress missed its funding deadline, and bam, the U.S. government is shut down for the first time in almost 7 years. Now, this might feel like, a political drama we've seen before, but trust me, the real story is not what you think it is.
Because this shutdown, it's like throwing gasoline on a fire that was already burning in the financial world. It is forcing a change, a huge one, that's going to affect pretty much anyone with a savings account or a 401k.
First off, let's just get this straight. This is not just another political squabble with some predictable, tidy ending. The language being used and the stakes themselves have completely changed.
That was the president's answer when he was asked how many federal workers he was planning to get rid of. Now, the most important word in that whole sentence isn't a lot. No, the most important word is layoff. And that one word, that single word, signals a massive break from everything we've seen in the past.
And look, this distinction is absolutely crucial. In every single shutdown before this, workers were furloughed. Think of it as a temporary leave. They were sent home, yeah, but they always got back pay. This time, the word flying around is layoffs, and that means something totally different. We're talking permanent job losses, programs eliminated, for good. It's a whole other level of economic disruption.
750,000. That's the number. That's how many government employees are furloughed right now. And with this new threat of permanent layoffs looming, a lot of them might never get their jobs back. This isn't just political theater anymore. This is a massive economic blow, plain and simple.
And you guessed it, that disruption spills right over onto Wall Street. For investors, this shutdown has created a sudden and pretty dangerous blackout.
You have to understand, markets run on data. It is their lifeblood. It's how they make decisions. But when the government shuts down, well, the agencies that put out all that crucial data, they shut down too. And this creates a really dangerous information vacuum. Investors are basically being forced to fly blind.
And we're not talking about minor stuff here. We're talking about the big ones. The Friday jobs report, the GDP figures that tell us that the economy is growing, the inflation data that the Fed uses to set interest rates. It's like the entire engine room of the economy just went dark.
And this really gets to the heart of the problem. Ursula Marchioni from BlackRock puts it perfectly. Right now, there are two competing stories about the U.S. economy. Are we heading for a soft landing, or are we about to hit a major slowdown? Without the hard data, nobody knows which story is true.
But here's the real kicker. This uncertainty from the shutdown, it's just accelerating something that was already happening. The old, reliable ways of investing, let's just say they don't really work anymore.
For decades, this was the absolute bedrock of investing, the 60-40 portfolio. The whole idea was super simple. When your stocks go down, your safe government bonds are supposed to go up, and they cushion the blow. It was the ultimate safety net.
But that relationship, it's broken. As Marchioni says, and this is a fantastic tagline, investors now need to diversify their diversifiers. What does that mean? It means the old safety net is gone. You can't rely on it anymore.
So that brings us to the multi-trillion-dollar question. If the old safe havens are broken, where is all that capital flowing? Well, the data shows it's already on the move. And I mean in a big way. Just take a look at this. Last year, about $7 billion flowed into European stock funds. This year, it's over $70 billion. That's a 10-fold increase. It's a crystal clear signal that big money is looking for safety, and it's looking for it outside the U.S.
But shifting money to Europe, that's just one piece of the puzzle. The most profound change, the one that's really reshaping the entire financial landscape, is the flood of money into private markets.
So why is this happening? Well, just imagine you're running a successful company. If you stay private, you get to avoid the tyranny of hitting those quarterly earnings targets. You can escape the public outrage over executive pay. You get access to these huge pools of private capital, all without the crushing cost of public regulations. It's a pretty sweet deal.
And the consequence of this is huge. As all the best and brightest companies stay private for longer, the bar for even entering the public markets has just skyrocketed. To even get noticed today, you have to be an absolute giant.
Let's put a number on that, okay? To get into the S&P 500 index back in, say, 2008, a company needed a market cap of around $3 billion.
And today, that number is $18 billion.
That is a 600% increase. The entire game has changed, and it's pushing more and more of the real economic growth out of the public's reach and into private hands.
So when you start connecting the dots, from the shutdown to the broken 60-40 portfolio, all the way to this private market takeover, you start to see it. A new financial world is emerging, and it has a completely new set of rules.
And as Franklin Templeton CEO Jenny Johnson makes clear, this isn't some accident. This massive shift is a direct response to a whole new set of pressures, everything from post-crisis banking regulations to the intense public scrutiny that comes with being a public company.
So what does this new playbook even look like? Well, it means investors are moving way beyond just simple stocks and bonds. They're going into a whole world of alternatives. They're holding gold, they're pouring money into private credit, they're using hedge funds, they're looking at emerging market debt, and they're betting on big thematic trends like artificial intelligence. This is the new diversification.
And this all leaves us with one final and I think really critical question. The public stock market, it was supposed to be the great democratizer of wealth, right? But if today's most innovative, fastest-growing companies are all staying private, accessible only to the largest institutions and the wealthiest individuals, what does that actually mean for the rest of us?